Okay, so you're trying to keep up, right? Information flying everywhere, new tech, new laws, and you just want someone to cut through the noise and tell you what actually matters.
It's a lot. Information overload is real.
Exactly. So that's what we're doing today. We're taking a deep dive into something called the Genius Act. Now, it just cleared a pretty big hurdle in the Senate.
Mm-hmm. Looks like it's on track to pass, probably by next summer.
Yeah, very likely. And the headlines, they're all about, stablecoin regulation, boosting innovation, protecting consumers like you and me. Sounds okay, doesn't it?
It does. On the surface, it sounds like they're finally bringing some order to the digital currency space.
Yeah.
Addressing risks.
Right. But, us, we don't just skim the headlines. We dug into this analysis. It's called The Coin and the Collar. The Genius Act is a trap, not a reform. It's by Dr. Jaime Hoerricks.
And it presents a perspective that's, well, it's quite different from the official narrative. Really challenges the whole premise.
It really does. So our mission today is to get past those talking points and figure out what this act really enables based on Dr. Hoerricks' analysis. And honestly, some of it is pretty surprising, potentially unsettling even.
Yeah, what's striking is just how fundamentally different the interpretation is. The official line talks regulation, security. Dr. Hoerricks sees it as something else entirely.
Okay, so let's jump right into that difference. Official story. Regulate stablecoins, make things safer. Dr. Hoerricks' view, this isn't really regulation in the way we usually think of it.
Less regulation, more foundation building.
Exactly. Building the legal foundation for, corporate-controlled money. They call it programmable scrip. It feels a bit like a bait and switch,
How so?
Well, it's sold as innovation, protecting your digital assets, but the analysis suggests it might actually be building a system where your spending is subject to the issuer's rules, compliance built in.
That phrase, programmable scrip, is really key, isn't it? It implies money that isn't just digital, but can have conditions attached. Restrictions programmed right in by whoever issues it.
Precisely. And this is where it gets concrete. The act allows banks, but also big corporations, even non-bank institutions, to issue their own private digital currencies. These stablecoins pegged, usually, to the dollar.
So not just crypto companies we might think of, but potentially everyday corporations.
Right. Dr. Hoerricks gives examples like, imagine an AMZ coin from Amazon, or Meta trying again with a MetaCoin 2.0.
Okay.
But it could go way beyond big tech. Think about universities issuing their own Ucoin for tuition or campus spending, or maybe school districts paying staff in a district dollar. Even health authorities giving refunds in health bucks.
Wow. Okay, so potentially dozens, maybe hundreds of different private digital currencies circulating. That's a very different landscape.
It really is. Now, there's this detail that sounds good. The coins have to be redeemable. Sounds reassuring, right? Redeemable for dollars.
Means you can get your cash back out, presumably, 1-to-1.
That's the idea. But Dr. Hoerricks points out that redeemable can mean a lot of things. It doesn't necessarily mean easily redeemable or quickly or without costs.
So the redemption process itself could be controlled.
Exactly. Redemption might be delayed. It might have conditions attached. You might have to pay a fee to get your dollars back. The crucial point is the issuer, Amazon, the university, whoever, they control that process. They control the gate.
So that seemingly simple word, redeemable, kind of hides a power imbalance. The issuer holds the keys to you getting the actual value back out.
You got it. The one-to-one pegging sounds secure, but if getting that dollar back is difficult or costly, it doesn't mean much in practice for the person holding the coin.
Yeah, that makes the promise of stability feel a bit conditional.
Very conditional. And this leads to some pretty worrying what-if scenarios Dr. Hoerricks lays out, things that could really affect everyday life.
Like what? Give us an example.
Okay, imagine you work for the LA school district, right? And you get paid in LAUSD coin. But then you find out your landlord only takes dollars, or you need, say, hormone replacement therapy, and that provider doesn't accept the coin. What do?
You'd have to convert it somehow, assuming you even can easily.
Right. Or picture getting your financial aid as CSU coin from the state university, but maybe you can only spend it at the campus bookstore or cafeteria where things might be marked up.
So instead of giving you flexibility, it actually restricts your choices and potentially costs you more.
Exactly. And it gets really concerning when you think about more vulnerable groups. Dr. Hoerricks raises the issue of undocumented workers.
How might they be affected?
Well, what if they're paid in some platform's coin, but because of KYC laws, Know your customer rules. They can't legally open an account to cash it out. They could be trapped holding coin they can't use for essentials.
That's a serious problem. Tracked value.
Or just simple system failure. What if their redemption platform for some branded token just breaks? People could be left holding worthless digital tokens.
So the risk isn't just theoretical.
Not at all. And Dr. Hoerricks sums it up powerfully. The people who are already struggling financially, the poor, migrants, marginalized communities, they stand to lose the most. Their autonomy, their access to actual cash, their time, their safety, they risk becoming just data points in these private systems.
It paints a picture where this isn't just a new way to pay, it's potentially a way to deepen inequality. Dr. Hoerricks uses this really stark phrase, building the machinery for programmable poverty.
Chilling, right. Not a better financial system, but potentially the opposite. So let's compare again. The Act claims to be a common-sense framework for regulating stablecoins, backed one-to-one by reserves. Sounds safe.
That reserve backing is definitely the main selling point for security. A dollar in, a digital dollar out. Seems straightforward.
But the counter-argument from Dr. Hoerricks is that, yes, the backing might be there, but what the Act really does is create the legal permission for private companies to issue their own money usable on their terms.
So the backing doesn't guarantee usability or easy access.
Right. Think about those payroll debit cards some employers use. The money is technically yours, but getting cash out often means finding a specific ATM, maybe paying fees. It's like that, potentially.
That's a good analogy. The friction involved in actually using the value.
Exactly. And the Act seems pretty light on meaningful limits. Who can issue these coins? Pretty much anyone approved. How can they be used to track or restrieve spending? Not many guardrails mentioned.
So we could see, like you said, schools, universities, big retailers, all minting their own currency with their own rules.
That's the potential landscape. And what's really missing, according to the analysis, is a strong consumer protection framework. What happens if your wallet's frozen? Or there's a glitch? Or the company just changes the rules? Where's the appeal process?
Yeah. With traditional banking, you have regulatory bodies, dispute processes. Here, it sounds like you might be left dealing directly with the corporation that issued the coin.
Pretty much. So Dr. Hoerricks concludes this act basically sets up private mints that hold a lot of power over the tokens people earn or receive. The power shifts significantly to the issuer.
And you mentioned the parallel to company towns earlier. That seems relevant here.
Extremely relevant. Dr. Hoerricks draws that exact parallel. Remember company scrip? Paid in tokens, only good at the company store, often with inflated prices.
Yeah, trapped workers, limited economic freedom.
Well, the argument is the Genius Act could basically digitize and scale up that model, wrap it in the language of financial inclusion, but achieve a similar kind of closed-loop economic control.
So the promise versus the potential reality. Let's talk about that. The tech vision is appealing, right? Modern money, programmable, efficient, maybe borderless. No bank fees, instant payments.
Yeah, it hits all those utopian notes. A sleek, modern financial system. Very cyber-libertarian ideals, in a way.
Yeah. Taps into real frustrations with the current banking system, for sure. Faster, cheaper transactions sound great.
But Dr. Hoerricks predicts the fallout won't be efficiency, it'll be fragmentation. Total mess, potentially.
Fragmentation. How so?
Well, imagine getting paid in work coin. Your aid comes as Unicoin, benefits are Gov token, but your landlord wants plain old dollars. How do you juggle all that?
Right, if they don't talk to each other seamlessly.
Exactly. There's unlikely to be easy, free conversion between all these different private coins. You'll lose value in fees, waste time navigating different apps, different rules. Instead of one system, you get these isolated coin silos.
Each with its own gatekeeper, its own rules, and probably its own surveillance built in.
You bet. And who gets squeezed the most in that fragmented system?
Let me guess. The people with the least power and fewest resources to navigate it.
Bingo. Low-income folks, migrants, people with disabilities, queer and trans communities, anyone already facing financial hurdles. If your food stamp coin wallet gets frozen, it's not just annoying, it's catastrophic.
And unlike a bank account issue, where you might have some recourse through regulators.
Here, you might be stuck dealing with a corporate customer service bot. No CFPB equivalent for Amazon coin. You're just a data point in their system.
That company script analogy just keeps getting stronger. Trapped in an ecosystem.
So who pays the price? Dr. Hoerricks is crystal clear. It's people with the least choice. It risks creating this hierarchy of currency. Dollars for the wealthy and a confusing mess of tokens for everyone else.
A two-tiered system.
Yeah. Think about that LAUSD worker again. Needs to pay rent in dollars, but has LAUSD coin. They face fees to convert, maybe delays getting the cash, maybe the wallet gets flagged and frozen for some reason.
Wow.
Dr. Hoerricks estimates people could lose like 10, even 25% of their earnings just to this friction.
Wow, 10 to 25%. That's basically a massive hidden tax on people forced into these systems.
It really is. Or the student with CSU coin. Maybe they can only use it on campus, where prices are higher. If they try to cash it out for rent off campus, maybe there are fees, delays, even like tax implications they weren't expecting.
And the undocumented worker scenario, forced to use predatory brokers just to turn their platform coin into usable cash because they can't pass KYC.
Terrible. And for trans folks, or people with disabilities, the programmability is a huge red flag. What if the coin issuer decides certain medical procedures or suppliers aren't approved? Your funds could just be blocked.
So the programmability becomes a tool for enforcing social or political views, potentially denying access to essential care or support, like mutual aid.
Exactly. And then there's the slippery legal thing. What even is the coin? Is it an asset? Property? Currency? A security?
Its classification matters for rights and regulations.
Right, and the analysis suggests the classification could shift depending on what benefits the issuer, leaving the user in a regulatory gray zone with fewer protections.
That sounds messy and ripe for exploitation.
Dr. Hoerricks argues it's not just messy, it's engineered for abuse in practice. It becomes a tool for influence, for discipline, for extraction.
Abuse in what ways?
Well, think about political grift. Imagine a Trump coin or a blue coin used for donations or rewards. Could it sidestep campaign finance laws? There's not much oversight described.
Yeah. Using stablecoins to channel political money with least transparency? That's concerning.
Then there's just plain old scams at the human level. Conversion scams, shady brokers targeting people who have to use these coins but don't know how to get cash out safely.
Preying on the vulnerable who are forced into the system.
And maybe the most insidious, institutional discipline. Imagine a university restricting how financial aid stipends in Unicoin can be spent, or an employer monitoring and potentially limiting purchases made with WorkCoin to enforce workplace policies or behaviors.
Yeah, it's a level of granular control over people's lives that goes way beyond just payments. It's behavioral control.
Dr. Hoerricks is blunt. For the average person likely pushed into this, there's no real upside. Only extraction, only conditional access. It's a digitized trap. Cash gets replaced by coin, autonomy by wallets with rules you don't set.
And those rules can change without your consent. That lack of stability and control is a core part of the critique.
Now, are there ways to resist? Dr. Hoerricks mentions possibilities, but they're limited, maybe risky. Things like lightning wallets, maybe relying more on cash, mutual aid, barter economies.
Sort of opting out where possible, building alternatives.
Yeah, but the main point is understand how the system is designed. Refuse the framing that it's just convenience or progress. Don't trade your autonomy for a slightly slicker app.
Awareness is key.
And naming it. Dr. Hoerricks insists we have to name the coin for what it is, a collar. Create that collective understanding so resistance is possible.
So looking ahead, the act likely passes. We'll hear lots of positive spin.
Oh, for sure. Innovation, modernization, inclusion. But Dr. Hoerricks' argument is stark. This isn't progress, it's the codification of our containment. Privatizing access to basic needs.
Moving towards a future where spending is tied to platforms. Maybe even social scoring systems.
That's the trajectory implied. So the challenge to you, the listener, is look at your own life. Where might a coin system first appear? Your job, your kid's school, benefits you rely on, be that warning bell in your community.
It requires thinking critically about dependencies and potential points of entry for these systems.
Yeah, and it's not just about money. It's about refusing a worldview that sees people as, programmable data points. It's about reclaiming the terms of access, defining value ourselves outside the market if needed, rejecting coins with collars.
Otherwise, the risk is what Dr. Hoerricks calls the birth of the algorithmic ghetto.
Exactly, a stark term, but it captures the potential reality. We need to build resistance that's visible, audible, and importantly, unprogrammable.
That requires conscious effort and collective action.
Absolutely.
Right.
And Dr. Hoerricks' final thought really sticks. That isn't some accidental bug, it's the business model. And people deserve better than a future dictated by corporate tokens and conditional access.
A future where basic living might mean navigating a dozen different digital wallets, each with its own rules and restrictions.
Right. Is that really inclusion? Or is it just a new digital cage? It's like they get the gold mine and we just get the shaft, dealing with all the friction and restrictions.
That's the provocative question to leave people with, isn't it? What kind of future are we building if this is the path forward? Control disguised as convenience, definitely something to think about.